my personal belief is I think we've got another 2 to 3 hikes coming. I think that those are going to be less severe than more severe. I don't think we'll hit. I don't think they're going to crank them off at 7.75, or 75 basis points each one anymore.
Hey everyone, welcome to our TDR Cannabis Exclusives. We welcome in a familiar face to our podcast. He's Rob Sechrist, the president of the Pelorus Equity Group and also the co-manager of the Pelorus Equity Fund. Rob, good to see you. How are things?
Doing well. Thanks for having me.
Great to catch up back again. Ben Smith, basically our lead financial writer, joins us once again. Ben, hope you had a good long weekend. How are things?
Had a great long weekend. Looking for a chat with Rob, one of our favorites.
Well, let's jump right into it. Latest numbers. You just pushed out your January distribution report, which appears that the fund has started 2023 the same way it left off in 2022. New figures show that the fund returned a 0.98% internal rate of return in January 2023, which extrapolates to about 11.78% annualized. So, Rob, straight up, your thoughts on the start of the fund here in 2023 so far?
Yeah, so our target yield is 12 to 15% net IRR, and we believe that we'll be well in that range. And this particular month and quarter, we're still trying to balance off some lower yielding, fully stabilized transactions that we closed prior to having everything going to floating rate, but we have some strategies that'll roll out through this quarter and next that'll offset that. And we've got some new originations that will just add income to the fund as well. And so we look to be closer to the 15 than the 12.
So when investors, what can they anticipate moving forward when it comes to, I guess, the same consistency returns that the fund has returned historically?
Yeah, so our since inception life to date is 14.12.
Okay.
And that's IRR, and 13 for cash on cash. I think that you easily count on a 12%, and if we can do better, we will. We're shooting for the higher, but that's I think is a fair, consistent basis to be there. It does move around a little bit each month because sometimes we have income events that are happen in just that month. It might be an exit fee or something like that we were not aware was going to for sure happen or not. And so that is income that just drops in for that 1 month as opposed to everything else is amortized.
Now, Rob, if we assume that the Pelorus Fund meets its performance goals like it has historically, a minimum of 12% return, you're targeting more closer to 15%. How would this performance stack up against other high-yielding investment security vehicles, such as I bonds or other, investment-grade debt?
So for other, for the bonds, I don't know if those are secured or unsecured to qualify what the underlying collateral is of those. I don't know if they're making monthly distributions. I don't know if there's a tax advantage for being in the REIT category. I don't know all of those things, but I will tell you, as comparative to other commercial real estate funds and even mortgage REITs that are non-cannabis ones, some of those funds are going to be more susceptible to a real estate or economic downturn. And with our fund, because we're solely specialized on cannabis use properties only, the reason we only are in that specific category is every investor has exposure to cannabis real estate, to real estate to some extent. I mean, in their portfolio, it just is natural. The cannabis sector is all those sales start with an individual buying a joint, buying an eighth, and those incremental sales are very small and discretionary, and those are going to happen regardless of what the economy, war, volatility in the stock market, whatever it is. It might slow down somewhat, but it's not going to go away. It's not like durable goods where, washing machines or TVs or cars comes to essentially a halt and pent-up demand is built up while people are trying to save up dollars and get through that economic cycle that they're in. So we believe that we'll fare better in those types of cycles, which we think we're entering right now.
Yeah, that's for sure. What's your thoughts on the overall, and I want to get back to this, but how we see things playing out with the economy over the next, say, 6 months?
So, it's hard to say where that's going to be, but my personal belief is I think we've got another 2 to 3 hikes coming. I think that those are going to be less severe than more severe. I don't think we'll hit. I don't think they're going to crank them off at 7.75, or 75 basis points each
Yeah.
one anymore. I think they'll be at 50 or less. But I think that the nearer term ones will be higher, 50%, than the longer term. So they need to let things shift through to see how much impact, because there's so much lag time from when you make that economic impact to where it comes through the economy. And so always the problem is to know when to stop or take push, let up on raising those rates and to try to time it right. And one thing that a lot of people don't realize is that the way that the U.S. market works and the nature of how employment and businesses and things happen today are different than the previous models that we had 20, 30 years ago, or even in 2009 when different cycles have happened. And so
How do you,
can't
can you
always
elaborate
get-
on that? What do you mean by that?
you just can't just take data from a different period of time and compare it to data today, because we're more in a technology and data driven market as everything moves a lot faster today than it did back in the Depression. And so you can't make those apples to apples comparison if you adjusted for inflation dollars and all that stuff. Those things change. The way that the U.S. market moves and the way that jobs move and how money flows through and the levers that we're pulling, it's never going to be exactly the same. So when people try to make comparative analysis, I think that history is always a good thing to look at, but also look at history of how things changed, of how the economics are changing from each of those periods to how you're evaluating that. And I think that's something that's missed.
Now, Rob, while we're talking about technology, I'm curious to know whether, like, you put a lot of stock into your proprietary data modeling and things like that. You rely on that quite extensively. Are you looking at things like Chat GPT and how they're revolutionizing the way data is aggregated and delivered, and sort of thinking about the next steps of incorporating that sort of AI into your modeling? Is that something on the radar?
Yeah, when we put in to Chat GPT what could we do best, and it said it wanted to smoke more weed, so we weren't sure who was running that over there. So I'm just kidding. I don't run that day-to-day project. That's a whole separate company.
Yeah.
And I think that regardless if it's us or any company that's analyzing big swaths of data and looking for new data points to add, you have to start considering that. So I think that for ChatGPT, you have to look at previous knowledge base to extrapolate where to go into the future. And it would be hard when you're the first one trying to plow something for an AI to miraculously generate out of thin air with no fact points to find, to go to know where to pull that stuff from.
Yeah.
So I don't know if it's possible from that perspective, but it certainly could take the existing data sets that we have and tell us what it sees. Because I have a good example of, this was not our company, but another peer of ours. They analyzed credit, and they were looking at what were some of the factors that were beneficial in determining if a good credit risk. And two of them were if they put commas in between the zeros on the application, and if they didn't round the numbers. And we're like, what is that? Would not be something that you, as a human, would think to look at. And they had statistical anomalies there that showed that these were things that, if they were actually putting the actual numbers in there, not rounding them, they were actually calculating those numbers, and that was something that was material.
Wow.
And the other one was, I can't remember if it was commas or space, but there was something in the ASCII code of how they entered the data that was something that a human just would never pick up on, that was identified. And so I think that that's always able to be, there's always information that can be gleaned there. Is it causality? That's something that needs to be determined for yourself.
Yeah, we've discussed that a few times already, Ben. There's a lot of information out there, but there's not much facts and opinionation as far as like what's accurate and what's not. Early days of AI, that's for sure. So you think there's 2 to 3 more rate hikes that are coming this year?
I think that is a fair conservative place to land. I don't think that I'm going out on a limb or I'm an economist in any way, but that just seems to be where the general consensus is. I mean, we all watch this every day. That's kind of what I'm thinking is going to be the case. And I'm thinking the recession coming at this point is less severe than initially prognosticated. All that's super subject to change because it could actually just be investors' sentiment that changes, and that tanks the entire economy right there. So if people think that it's not going to be as bad, that generally is a self-fulfilling prophecy. And if this is a rolling recession where not all sectors are hitting at once, that's good and bad. The bad part is that they're not going to see the effects of the rate hikes come through as much as they want because it's disproportionately hitting the tech sector and not hitting the other sectors at the same time, and so that might prolong this downturn that we're entering, this recession that we're entering into.
Now, Rob, this year there appears to be some stabilization in the equity of some U.S. cannabis operators. Finally, after quite an extensive period of multi-quarter decline, and that may infer that the worst of the headwinds facing these companies may be over. If you believe that equities are a forward-looking mechanism of operations 12 to 6 to 12 months out. Now, are you seeing the same things from your end, from the people that you talk to? And that industry headwinds are abating somewhat, and that normalization of industry operations is happening?
So first, I would say that the forward-looking of equity markets is generally a true statement in fully normalized markets with lots of history and no regulatory reform or new markets continually opening. In the U.S. market, I do not think it's an indicator. I think that there's you got to always go more granular in the companies and what they're doing. And, we think that, there's some companies that are going to do good and some are going to do bad. And just because you did better because you were a first mover in Illinois or Florida or wherever that might be, does not necessarily mean that you can hold on to those margins in that equity valuation that you once had as the market, even in limited license, become more efficient and become more difficult and the customers become more experienced in picking what they want.
Absolutely.
And so I think it's a dangerous place to make those assumptions. And I also think that in this particular sector, it's so nuanced and the product is so important. It's not a commoditized product in sense that it's going to be a sponge that a simple product that really there's no feature or variability to it, a commoditized type product. Cannabis is not that way. You have not only the quality of the product but the image of the brand. And those things, the brand image can change and the product can change. And so as new products are coming online, even with an existing competitor that wasn't doing very well before, they may be forced to make a radical change in their product or the way that they're doing business that might shift the game so quickly that a big operator didn't catch that shift. And now that brand equity has significantly increased for that small operator, and that it's difficult for the big guys to regain that. And so they keep continuing losing equity, brand equity, valuation equity, as the little guys are scrappy, can afford to take hits and shots at it. But eventually, one of those little guys are quick and nimble, and those guys are the ones that you got to watch out for. So when you're a big operator, you're just a big molasses, and you got guys making decisions at the top that may or may not be listening to the guys that are on the ground because they don't have a personal relationship to give them credibility to listen to them in real time.
Okay, so you're saying that the equity prices are not necessarily a reflection, even though we have some stabilization, and that the general rule
that was a long way of saying that may not be a great way to look at things.
Well, we talked in our last podcast, market share will not be the focal point. It's all about profitability this year. And since we last spoke, we've seen some announcements, the Curaleaf walking away from a couple of states. We've seen even Air Wellness, big dispensary in Chicago. I just found out number one market share, to your point, in the highly competitive Massachusetts market was this little sleepy MSO, otherwise known as MaryMed, that's outperforming all the big MSOs in this market. So needless to say, times have changed. But when we look at, as you said, like 2 to 3 rate hikes that you think will take place the remainder of the year, I have to ask, like with a higher interest rate environment, that's going to elevate the rate of return for other investment products that have, I guess, basically a relatively fair safety profile. So when I look at this, I guess, overarching view, explain maybe the benefits as to why it makes sense for people to continue investing in your fund versus, say, an elevated return profile of like other competitive products.
Yeah, so I think we kind of touched on this a little bit earlier, but we're secured. We're making monthly distributions.
Yeah.
You can redeem after 6 months. We have pretty generous liquidity redemption ability out of the fund, and we have people coming in and out at all times. This is an asset class that we believe is going to fare better in these types of real estate or economic down cycles that we're in. And so I think that I don't really think of it as more of a binary choice. I just think of it looking at your entire risk profile of your investment. And you have a certain portion of stuff that is going to be secured or cash flowing yield. And when you're at that double-digit returns, generally that's more of an equity-like return. And generally, those types of investments are not making monthly distributions, and certainly not under a REIT format, or not that many are in that structure. And so I think it comes down to, okay, I want to get a high yield, tax benefit, secured. I want to be an alternative specialty use asset class because I've got enough exposure into the real estate. It's just a matter of defining. If I've got $100,000 in this particular bucket, do I want it all to be non-cannabis, or do I want to have some diversification? So that's how I would be thinking about it. And during COVID, we had some of the largest growth we've ever had in our fund that year. And I think that people realized that going through that, they weren't sure what was going to happen with rent rates and for individuals and for companies that were leasing. And so they realized they probably had too much exposure to just that particular income type property funds. And so they wanted to diversify into one that had less susceptibility if there was some significant pressure in the economic cycle or the real estate value cycle.
Is the goal, I know we've spoken in the past, the goal is still on track to get to over $1 billion in assets within the next 12 months?
Yeah, that's our goal. We believe that we've got the pipeline and the staff and the data to do that. It becomes a little bit more challenging too for us. We are affected by the inflows of equity as well. High watermarks of $20 million a month are now closer to $5 to $10 million a month. But we still believe that we're going to be. I would say that we'll be at that goal no more than 24 months, but it's possible to get there even still by the end of this year.
Still garnering a lot of conversation with a lot of, without naming names, but I would think that with rising interest rates and a very complex environment around cannabis, a lot of conversations going on with a lot of people in the space.
So the origination team is always talking with people. We are starting to see and hear, not necessarily directly from the borrowers, but we're hearing from their advisors that have been hired or engaged to start looking at potential options of what might be necessary to do. But that's a very small sliver of everything that we are looking at. I think that it is a big misnomer out there that the entire $27 billion of revenue coming through the cannabis industry is all non-profitable. That is not the case. There is many companies that are not only able to make cash flow but doing well. there's certainly people that have made cash flow and now are not. And it's just a factor. And sometimes that happens in cycles of each particular state, that there might have been an oversupply, and, you needed to save up some money from the previous year where you had an undersupply and made some extra cash. So some of the outdoor wholesalers in California have had to do capital calls from their partners, and those guys are going to make it through. Whereas the other guys that didn't save their money, or their partners couldn't do the capital calls, those guys are not going to be there anymore. So the price is already coming back up on outdoor wholesale, and I think that market is shrinking. So it'll be an up and down on a slow trend up over time.
Now, last question on my end, Rob. Do you have any anecdotal conversations about how the cannabis has been affected by the recent atmospheric river that rolled through California? Should we affect? Is the spring planting season going to be different, or what do you expect there?
I think we had chatted about this before, where we had prognosticated about that. But I have been so busy, I haven't had a chance to follow up or get any data on that, other than we do see that the price is starting to trend back up slowly for outdoor wholesale, which would be that market that we were discussing that probably got impacted to some extent from the atmospheric river that we had go through. Now, granted, most of that came through after the harvest of October, but that's probably might have some impact.
Have we seen a bottom in wholesale prices, you think? I know they've been sort of floating near the bottom of the range.
Well, for last year, we're already past that last year, but if we already saw a bottom, and now we're into this year, and so I think that this current 2023's bottom will be higher than last year's bottom. So you want to, it's going to cycle through each year. It's always moving, but I think that there will be less suppliers than for the same amount of product that needs to be produced. So it'll come back up.
Last thing I'll ask too, Rob, is do you think in 2 years from now, you've talked a lot about this being a big year for you as far as growth. If you're here today, 2 years from now, look back at the year 2023, what would you say it is?
What would I say was our strategy for growth?
Strategy for growth. If you had to look at, when people look at what are we going to anticipate from now until the end of 2023, you talk about big opportunities, high interest rates going on, downturn in the market. This is where you thrive. A lot of influx on the equity side in the cannabis space. All that points in the right direction for what your model is. So if we're sitting here 2 years from now, looking back at 2023 in a recap, what would you say that would be?
Yeah, well, a couple of things. One is that most of our peers are not able to issue credit as easily or as quickly as we are right now. They're under some capital constraints, and granted, all of us have had some slowing of equity inflows, but we're not public, and so we're not having to sell equity at a down, at an under book value price or do those types of things. So everything that we raise is at par, so it becomes more attractive during this time. But we're working on some strategies that I'm looking forward to being able to announce with you guys.
I love the smirk on his face when he says that.
Probably later, at the earliest in this quarter, but probably not till second quarter, where those are such major announcements of how we've achieved some key things in this sector that will allow us to take more market share of what our peers have not been able to fulfill. And also our brand and how we do deals is a different type of structure. And generally, we're slightly less proceeds on or could be significantly less proceeds than some of our peers. But I think that people are realizing that if that might be a better long-term solution than when you get into a situation and you have covenants that you're not able to meet within the first couple of quarters of your loan. And once you start breaking those covenants, your rates change or everything starts changing on your deal. And what additional funds you might have coming may or may not be coming anymore. And so that loan that you thought you had for more proceeds is really not able to be facilitated.
All excellent information. I guess that's the topic of our next conversation with you is how do you do this and how does it work? But I assume that you don't want to give away the recipe too much. But needless to say, always learn from you.
Happy to talk about it at the high level and happy to talk about what we did after we make it public.
Yeah.
But there's some pretty cool things in the work right now.
Great stuff. We will see you in a couple of weeks at this Benzenga conference in Miami. I can't believe it's going to be April in no time, but I hope you're enjoying life in California as we, Ben and I, get through this nice, beautiful Midwestern winter cold.
Sounds good. Always a pleasure to talk with you guys.
All right. Thanks, Rob. Appreciate your time. Hey everyone, thanks for watching. And if you want to learn more about the emerging industries that we cover, then leave a comment below and let us know who you want us to interview, the questions you want asked, and the information that you want to learn. We want to hear from you. As usual, click on that bell for all notifications to get the latest information. Share this video with your network, and don't forget to subscribe to our channel because we would not be here without you. Thanks for watching, everyone.